Hi, this is Dan Collins coming to you live from Traders Expo, New York. I'm joined with Robb Ross, who is founder of the CTA White Indian Trading. Good to have you here, Robb.
Thank you, Dan.
All right, well, you have a unique take on options, and why don't you explain to our audience what White Indian Trading?
So White Indian Trading is called that because I'm actually a 16th Chickasaw Indian and a 5th Scotch. So registered with the Chickasaw tribe. And so I launched the CTA 13 years ago, and I've come up with a method called the alternative hedge method, which basically what I'm doing is instead of doing naked option premium selling, which I think is pretty dangerous, is I actually hedge with the underlying futures against the option premium I've received. So basically I receive the premium, and then I'll put stop orders, a buy stop above the call strike, a sell stop below the put strike, and the underlying futures, those markets, those orders are in, while the markets are trading 24/7. And so if I get engaged on a trend up or a move down, then I've got a covered either call or put, and can try to avoid kind of the catastrophic stuff that happens with selling options. So the negative about it, of course, is that I can't get whipped in the futures. So that's why I'm constantly doing research on, is just try how to reduce my drawdown. I do have to say, as a CTA, past performance is not indicative of future results. So I have to put that caveat in there also.
Okay, well, I mean, when you originally came out with it, it had more of an R-rated name, I think.
So when I first started, it was called the Scantily Clad Straddle, and then the Scantily Clad Strangle, because I was basically doing options that were partially covered on one direction, so they're scantily clad or partially covered. But my wife thought that was really what was off key, but she knew the brokers would love the name. And so then later on, getting more towards institutional money and pension, we changed the name to Alternative Hedge Strategy.
It's important because I think 10 years ago, the first options related panel I did, you might have been on it or not, I can't remember, but we were trying to gauge the audience, and we had them raise their hands, and it turned out that more than half of the audience of retail traders were doing naked option writing, which can be dangerous, and it can be, I don't know what you could say, maybe intoxicating in the fact that you can make money on it almost by accident without realizing how much risk there is.
Basically, what a lot of the naked option premium sellers did forever was they'd sell way out of them. And of course, there's a skew on the S&P futures or even the S&P equity options, is that the puts are usually priced more heavy or more premium as compared to the calls an equal distance away on the market. So they'd sell a lot of puts out of the money, and 90% of the time they would show profits. And what some of these guys were doing is if the market actually moved against them, they would buy those puts back, and then they'd roll into and sell like 3 times as many puts. If it kept going against them, then they would buy those back and they'd sell 3 times more of those. It was almost like a pyramid scheme in the way that they did it, and they'd show profits 90% of the months, but people didn't realize the inordinate amount of risk that they were taking. And so when you have events like what happened a year ago in February, and we saw a firm that had a growth preservation fund that went down 82%.
Yes,
and it was 90, and they were doing naked only option selling, and they didn't have the risk controls in. And so it's real important to have your risk controls in, do credit spreads. Like what I do is I hedge with the underlying futures. So once it starts moving, I'm going to be long or short of the futures to cover that. So you have to really manage your risk, because some people just thought as almost like a bank where they're just going premium every month, and it gets scary when things go bad.
It's almost a case of you think it's too good to be true, it probably is, and that's what people get drawn in by the consistent profitability of writing options without giving enough thought to the risk.
And that's with any kind of investment, is always the risk. I mean, sometimes you'll get people who will buy a stock and just hold on to it forever, and it just keeps going against them. I've seen hedge funds or mutual funds or other funds I've read about that bought a stock at 30 and rode it all the way down to 5 because they believed in the stock. And I mean, they're taking a huge hit riding it out. So it's always having that exit point and those risk parameters in place that can give you, basically what you want is to lick your wounds, learn from the experience, and have enough capital to be able to play another day. And if you do that, you can have a longevity in these markets.
Okay, well, we're going to take a quick break and be back with more with Robb Ross from Traders Expo, New York.